Hello everyone and welcome to this Economic Impact video. Today is July 15. As usual, I am with our Chief Economist, Stéfane Marion. Hello, Stéfane.
Good morning, Martin.
Lots happening with inflation, Stéfane. What's going on?
Still a challenging environment, Martin. We spoke to that a few weeks ago, and unfortunately, inflation remains on an uptrend, reaching more than 9% in the US, with a low unemployment rate. Clearly, the central banks are becoming more aggressive. They can no longer tolerate higher inflation, so they're moving in quickly to try to limit any further upside.
Yeah, so they are being somewhat bulldozed by those numbers, right?
Yeah, and we can see that the reaction function has been quite aggressive in Canada. Even prior to seeing the next inflation print, the Bank of Canada opted to make a little bit more room to maneuver on that front, and they hiked interest rates by 100 basis points, something that had not been seen since 1998. So. I've never seen this since I started working at National Bank, but clearly an aggressive move. Here's an easy forecast, Martin. The next move will also be aggressive, and the Federal Reserve will also probably show a full percentage point increase or slightly below as soon as the end of July. Again, the importance for central banks is to get in front of inflation as opposed to trailing inflation going forward.
And Stéfane, some people are asking us if this is looking like the 70s or all over again.
Well, you saw in the previous slide that clearly the last time we saw inflation running well ahead of the jobless rate was the 1970s, which were a period that was also characterized with supply shocks. And we do have supply shocks. We have war in Ukraine, and we also have the Chinese situation with the zero COVID policy strategy, which is impacting the global supply chain. So there are similarities, Martin, and that's important to keep in mind, because if you're dealing with a supply shock like you did in 1970s, it's important for central banks to be able to make the difference between what comes from demand versus supply. So hopefully, as the global supply chain normalize in the coming months, which we hope it will, then that would certainly help on the inflation front. So there are similarities with the 1970s, nothing.
And Stéfane, obviously the stock market reacting and remaining in bearish territory.
Well, if you can't predict the central banks nowadays, obviously it's not great for equity markets. And equity markets were down more than 20%. It was bear market territory if you look at global equities, and we've recouped some of the losses, Martin. And as we speak, we are close to we're still close to the lows. We're not lower than we were back in June. So that's good news, Martin. So people will tell me, okay, why is this happening if inflation is accelerating? It's because you have to look at expectations. Never forget that inflation is a lagging indicator on the economic cycle. What we're seeing now, Martin, quite interestingly, is that inflation expectations are actually coming down. So as inflation is coming out officially with higher right now, forward-looking indicators or market expectations is for deceleration, and inflation expectations for the next 5 years now are the lowest we've seen in over a year. So I think that's a positive development that helps support the stock market so far.
And that's a very important point, Stéfane, and probably our main message today. But let's look at some of what's behind these lower inflation anticipation. And you know, I like Dr. Copper, so not looking good.
No, so it's counterintuitive to see why inflation expectations coming down while inflation is still accelerating. It has to do with exactly what you're saying, Martin. Commodity prices are decelerating. We already know that there's been a significant increase in interest rates globally in recent months, and clearly that is leading to slower global demand, and that's impacting commodity prices. Oil is down 20%, Dr. Copper is down 25% or so. So that in itself will feed into the inflation numbers later this summer. So maybe we are near a peak on inflation. That's obviously our forecast at this point in time. And if we are near a peak on inflation, that means the scope for super aggressive central banks in the months ahead is significantly lessened. So that is a very important development that we see these commodity prices coming down.
And also the price of transportation is a key indicator of what's happening with supply chains.
Yeah, so On that front, I would say that there's been a partial reopening of the Chinese economy, so the price of shipping a container from China to the U.S. West Coast is down by more than 50%, Martin. So that in itself should also translate into lower consumer goods inflation, since a large component of that are imported goods from China in the coming months. And Martin, we're actually already seeing it. So that's important. That's how you stabilize inflation. And one of the reasons why we think these consumer goods might come down, Martin, is because less demand due to the fact that the very big increase in the energy and food prices that we've seen in recent quarters has meant that U.S. consumers have been forced to redeploy a massive amount of their disposable income towards spending on food and energy, $500 billion, Martin. So obviously that means less money for discretionary spending. So if you spend less on discretionary items, obviously you'll bring down your inflation.
And this obviously should have an impact on our enterprises and an impact on their earnings.
Yeah, so everyone's concerned, and you mentioned the 1970s previously, Martin. So everybody's concerned that will we get a rapid increase in wage inflation due to this increase in food and energy prices? And the way to avoid this, Martin, is what will be the reaction function of corporations in the coming months after a very solid hiring pace over the past year or so. So what we're seeing right now, Martin, is with the deceleration of discretionary spending, there's less upside for corporate profits in the months ahead. And in the US, only 35% of corporations are guiding up in terms of their earnings per share for the coming year. That's not the type of diffusion you normally see. It's lower than usual, and that would suggest a slowdown in the hiring pace already this summer. And if you slow down the hiring pace, doesn't necessarily mean layoffs, Martin, but if you slow down the hiring pace, say from 400,000 people a month to something closer to 100 or slightly below 100, that's key to avoid a wage inflation spiral. So that's really important. And the indicators that we have right now, the forward-looking indicators, do already suggest a tangible slowdown in the hiring pace this summer. So again, if you want to bring down inflation, Martin, you've got to slow down the hiring pace. You've got to cool demand for consumer goods, and commodity prices must come down. So it seems that the planets are aligned now for a peak on inflation, and I think that will be supportive to markets if we could confirm that inflation slowdown in the coming weeks.
Yeah, very interesting, Stéfane. And again, to reiterate, you're talking about a more modest growth, but still in growth territory, and Canada on a different path.
That's partly the reason why the Bank of Canada was so aggressive this month, 100 basis point increase. The Canadian economy is doing well. The labor markets are solid. We have the lowest jobless rates in the 1970s, below 5%. We've seldom seen this, Martin. And people are concerned because they ask me when they see this, is they going to see a wage spiral in Canada? Are we facing these massive labor shortages? What's going to happen? Does that mean that the Bank is going to have to up the ante on rate hikes? Martin, I do recognize that the jobless rate is the lowest in the 1970s. These are tight labor markets, don't get me wrong. But at the same time, the immigration policy is quite supportive right now for domestic growth and for replenishing of the pool of available workers. And you can see that the population aged 25 to 54 is growing at a blistering pace right now, 220,000 individuals per year, something we haven't seen since 1993. That's 90% driven by immigration, Martin. So clearly, our corporations in Canada, unlike the US, are accessing a pool of available workers that's still growing. So that limits your upside on wage inflation. And obviously, if you can do that, then that will limit the potential for monetary policy to be pushed into restrictive territory on this side of the border.
And Stéfane, it should also provide some support to the real estate market.
Well, that's an interesting question. We've seen a significant drop in home resale activity in this country with the higher mortgage rates. But at the same time, Martin, yes, home resale activity will be slowing, but home starts, home construction will have to remain relatively high just to support these demographic components. So there's an offset to lower home resale activity through higher or resilient home starts, I should say, in the coming quarters.
So, Stéfane, in conclusion, we are not in the recession camp. We are counting on a deceleration of inflation in the coming weeks and months. That's really the main message. What about interest rates?
Well, we see them topping near 3%, Martin, not the 4% that the central banks are advertising right now. We're really encouraged by the fall in commodity prices that we've seen recently. Also, the drop in inflation expectations and a potential reopening of the Chinese economy. All that argues for a peak on inflation. We need to confirm it, Martin. But if we can stop the central banks at around 3% on their policy rates, I doubt that this would imply restrictive monetary policy and topple the economy into recession. So again, stabilizing inflation is key. The next few weeks will be very telling as to whether or not the central banks are forced to push monetary policy in restrictive territory. That's not our baseline forecast. We're encouraged by the inflation dynamics. Now it's just a matter of confirming our forecast.
Excellent. Thank you very much, Stéfane. Thank you, everybody, for listening to us. We will be back in about a month, and enjoy the summer. Take care.